All right, let's go ahead and get this started. My name is Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm that covers disruptive tech for a global audience of institutional and retail investors. So today's presentation is titled How We Manage Our Tech Stock Portfolio. What we want to accomplish today is to give everybody an overview of how we go about purchasing new positions, how we maintain existing positions, how we determine how much money we're going to sink into a particular stock, how we weight our portfolio, and the details surrounding the management of our portfolio. So, one of the things we do is eat our own dog food. When we talk about stocks, tech stocks, will classify them into three categories. There's a void, which is the majority of stocks we come across. Then there are stocks we like, which means that we wouldn't mind owning those stocks. And then there's stocks we love, and those are the stocks that we own. So today we want to talk about how we go about purchasing stocks that we love and how we add to them over time. Now, if you'd be so kind as to just put questions on YouTube in the comments section, we'll go ahead and address those so that everybody can see the answers. Feedback's always welcomed on these presentations so we can get better at what we do. Now, before we get into talking about tech stocks, I wanted to point out something that's not necessarily so obvious. When people hear us talk about tech stocks and the positions we're going long and our views on the overall climate of tech stocks, what many don't realize is that's a small part of where we've made our own bets. So you kind of think of ourselves as a family office, and actually, all of you are your own little family office, right? You have money that you've saved, and you have home equity and all these bits, 401ks, things like that. And if you took the total assets that you have, and then those are called your assets under management, and then looked at where they were placed, that's called asset allocation. So you place your assets across different asset classes. An asset class is a stock, a bond, real estate, could be things like wine, art, Bitcoin, or gold. Now, this is our assets under management, the allocations that we've made. And as you can see, Nanalyze there, that's around a fifth. And actually, that number is less than a fifth now because tech stocks have dropped dramatically. Less than a fifth of our assets are in tech stocks. The majority of our assets are in our dividend growth strategy, Quantigens, and we've put a video out on that so you can check out what we're doing there. And then the rest of our assets are spread across things like funds, so we avoid domestic bias. We have some international exposure there. We have some cash, wine, art. Wine is through VinoVest, art is through Masterclass or Masterworks, and Bitcoin and some gold. So what we're going to talk about today is the 20% of our assets or less now that's in tech stocks. When we set out purchasing tech stocks, we divide those up by the categories that we cover. And we needed to come up with a total number of stocks for our portfolio. And what that ended up being was no more than 40. So right now we have 37 positions. This includes two ETFs. We'll be getting rid of those ETFs. So really we have 35 stock positions, but overall we have 37 positions. In order to determine a target weighting, we want to have an equal weighting across all positions ideally. Or let's pretend that if we were going to create our portfolio today, that's what we were going to do. Some firms will weight by market cap. We simply do an equal weighting to keep things really simple. So if we needed to figure out the target weighting for an equally weighted portfolio of 37 stocks, you simply divide 1 by 37. So if you have a 30 stock portfolio, divide 1 by 30. That gives you the target weighting. And as you can see here, in an ideal world, a 37 stock portfolio that was equally weighted would have weightings that looked like this. So we call that a target weighting. Now, the actual weightings are a lot different from that. Why? Well, when you purchase a stock and it moves a lot over the years, then that starts to increase weighting. When we purchase a stock, we don't necessarily add the entire weighting all at once. So we're going to talk about that. But these are the actual weightings of the 37 stocks that we're holding. As you can see, only 5 of those stocks are over our target weighting, and the rest are under our target weighting. And we also have a fair amount of cash that we can use to add to positions that are seen there in red text, so positions where we haven't reached our target weighting. But there's also one thing that we need to consider, which is how much money we're going to put into any particular stock. Now, here's an example of what a $100,000 portfolio would look like. If we had $100,000 and we had 37 positions and we wanted to put an equal amount of money into all those positions, we'd put $2,700 into every position. That's if our total portfolio value was $100,000. So, in order to figure out what our target capital per position is, simply take the value of your portfolio at any given time and then multiply that by your target weighting. And we've used a value of $100,000 here as an example, but the value is whatever your portfolio happens to be valued at any given time. And then you don't commit any more than that into a new position or an existing position. Now, because that number fluctuates over time, there may be instances where you have a number of positions that are well over that as tech stock sinks, and that's fine. This is simply meant as a guide to let you know not to sink too much money into any one position, and they call this trying to catch a falling knife. So if you have a position in your portfolio that keeps falling and you keep adding, you can add a lot more than $2,700 and never reach that target 2.7% weighting. So this is a way to keep us from catching falling knives. When we're buying a new stock, here's how we go about doing that. And all the things that I'm talking about today, this is just kind of how we've evolved over time and how we approach managing our portfolio. There's no right or wrong way to do this, but this happens to be how we do things. So when we buy a new stock, and you can look at our methodology, which describes how we go about finding attractive stocks to invest in. When we buy a new tech stock, we'll start out by buying a third of a position size. So going back to that example of $100,000, if our target capital was $2,700, we would put in $900 into to start the position, and usually we'll do that quite quickly over several days. We'll establish that position, and then that's it. Now what we do is we wait. Stock rises, that weighting goes up by itself. The capital and the position rises, and life is good. We're happy because our money's going up. If the stock falls and the weighting falls as well, that stock is now on sale, and we're equally happy because now we can buy that stock at a discount. So after we've established that initial position, the third of a position size, we will then decide to add to it when the price of the stock falls below our cost basis. So when we talk about cost basis, this simply means the average price that you paid for the shares you're holding. So we've given an example here where we've taken a stock, and you can see that it's priced at four different price points, and we've purchased a number of shares. This is just an example, and we have 85 shares at the end, and we paid $948 for those 85 shares. So we divide 948 by 85, we get $11.15. That's our cost basis. So the amount of money that we put into that position is $948. We now have 85 shares. That means we paid $11.15 per share. So when we're holding that, if shares fall to $8.93 or less, that means the current share price is 20% below our cost basis. And when that happens, that's when we'll decide to add some shares. Now, that target 20% can be whatever percent that you like. For us, it changes. So lately, we've changed that to more around 30 or 40% as tech stocks take a massive dump. But that's how we go about adding shares. We take that initial position, a third of our position, and then we'll add shares. Now, how do we add shares? Well, when we see a position is on sale, one that we're holding, and we decide to add shares, and people will say, well, how do you decide? Well, there is also some subjectivity around this. We try not to add try not to do more than one trade a week. We alert our subscribers, our premium annual subscribers, when we do make a trade. We'll usually alert them on a Monday so that we have 5 days to do purchases. We identify that position, and then what we do is this. So we provided an example here. We've already bought the third of position. Now there's a dip. So for 5 days, we'll do 5 buys. And the amount of capital we commit with each buy is approximately 3 to 5% of the target capital. So going back to that $2,700 example, so we have a $100,000 portfolio, a target of $2,700 for each position. So if we were going to do 5% of that, that would be $135, and we would do that over 5 days, right? So that's if we were doing 5%, right? We could do anywhere from 3 to 5% per buy. That means that at the end of that week, around 15 to 25% of our target capital has been spent on purchases. Now you can see in the example here, in a perfect world, this is what things look like. So day zero, we buy that third for $900, and then on a dips down below 20%. We add for 5 days in a row at $120 per day. Now we're at $1,500 in that position. Then we wait. There's another dip, or it keeps on dipping. We'll add for another 5 days, right? And we've committed another 600. And then on the next dip, we'll add for another 5 days. And now we've committed the total amount of capital. And this is an important point to make. So when you have stocks that fall rather dramatically, and we have some of those, what will happen is you'll have committed all your capital, and still you'll find yourself down 40 or 50% on below your cost basis. Now, that's never comfortable for investors to see all that red, to see those paper losses, but that's the reality of investing in tech. Things are very volatile. When that happens, you don't add more capital. You already committed the capital that you wanted to, and then you leave it at that. So there were some other considerations here to think about. We talk about adding new stocks to our portfolio. As I said, we have 37 positions. Really, those are 35 positions because the two ETFs don't count. Our target is 36 with 40 maximum. The way that we came up with 36 is we cover 12 tech categories. Multiply that by 3, 36. We add a bit of a buffer. 40 is a nice round number. So no more than 40 stocks. If we decide to add a new stock, there has to be a very good reason for that, and that's always taken into context what we're already holding. And then going back to that cost basis target, if a stock that we're holding, if the price goes 20% below our cost basis, we've changed that to 30 or 40%, and we have stocks that are 50% below our cost basis that we've already committed all the capital to. So in today's volatile market, you've got to be comfortable with having large paper losses. And one way to do that is to not have all your eggs in one basket. If just a fraction of your wealth is tied into tech stocks, and then just a fraction of that is in a tech stock that's down 50 or 60%, it's not anything you lose sleep over at night. So with positions we've maxed out, doesn't matter how low they fall, we don't chase falling knives. That's it. And then there's this idea of value at risk. I think more holistically, when you look at your tech stock portfolio, you've got to be really comfortable with seeing a lot of red. And if you're a tech investor right now, you're experiencing what seeing a lot of red feels like. There's a notion in the finance world of value at risk, and institutions will measure this. And companies like MSCI, they provide tools, risk management tools that let you analyze your portfolio, and you can actually pull up scenarios and say, okay, if I was holding this portfolio during the Gulf War, what would have happened? Or during the dot-com crisis or the housing crisis? And it'll actually go through and show you what your portfolio would look like. Now, what a question institutional investors often ask is value at risk. And you can think there's a lot of reasons why somebody might want to know this. Tell me with a 95% certainty how low my portfolio can go, right? This is a concept known as drawdown. So the high water mark is the highest value your portfolio has reached. And everybody probably knows that in their mind because we're humans and we pay attention to that. And then when you take the difference between that's called a high water mark. Think about a pool, the highest level that the water goes in a pool, it leaves a mark when it goes back down. It's a high water mark. Now, the difference between that high water mark and where your portfolio is at today is called a drawdown. So value at risk simply says, tell me with a 95% confidence, what's the maximum amount of drawdown I could have in my portfolio? Well, guess what? We don't need a sophisticated tool from MSCI to answer that question. In the dot-com days, and that was a time where if you had money in the market or you lived through that, then you know very well how bad things got. But this is a good example here. In the dot-com times when the stock market just completely tanked, there was an 80% drawdown, all right? And this, we're not talking about small caps here, we're talking about Intel and Cisco. These companies were down 80%. So if you think about having a portfolio that's valued at $100,000 right now, if you have that, your value at risk could be 80% of your portfolio. So that means you'd have to be comfortable with that $100,000 you have today falling all the way down to $20,000, and you'd have to be comfortable. Think about how uncomfortable that would actually be, especially if all your wealth was tied into that $100,000 portfolio. When that happened, it then took 14 years for the value of those stocks at $20,000 to get back to $100,000. That's the nature of tech stocks. That's the nature of volatility, which goes both ways. And we've had a bull market now for the last decade, a very, very strong bull market. People seem to forget that stocks can go in the opposite direction, especially volatile tech stocks, just as fast. So when you're putting together your portfolio and you're adding, just always remember that you may think 50 or 60% below your cost basis is a super bargain, but what if your entire portfolio on average was 80% below the cost basis? That's something you need to think about. So, last thing I wanted to touch on was selling stocks. Now, we when we buy stocks, we do so with a very long time horizon. And our recent presentation on Berkeley Lights gave a good example of why we might sell a stock when our thesis changes. Hopefully, your thesis isn't changing for a lot of your positions. It shouldn't. Now, with Berkeley Lights, the thesis changed, and we talked about why that was. Other sales that we've had have surrounded a thesis change in the case of one I could think of, and also corporate events. So, companies that are acquired by private equity firms, acquired by larger companies, mergers and acquisitions, things like that. These are clearly times in which you may exit a position, then you have cash, and then if there's something else you like, then you can consider that. So when it comes to selling stocks, we don't do a lot of selling at all. The positions, we buy quality companies and we hold them with a decade-long time horizon. So we don't talk a lot about selling stocks because we don't sell a lot of them. Now, the same notion may come into play if you're deciding to exit a position. You may exit over a period of time to avoid trying to time the market. So you may sell a little bit on one week, a little bit the next week, maybe do that over 8 weeks and exit your position that way very slowly. Like we recently swapped out two positions, and as we were buying one, selling the other, we did that over a couple of weeks. So the same notion of dollar cost averaging when you're buying can also be useful when you're selling. And sometimes you may just choose to sell all at once because you just want to get away from that risk. That's what we did with Berkeley Light. So that's about all that we wanted to talk about today. There's a living document that you can read. If you Google Nanalyze methodology, this talks about all the criteria we use when we're looking for quality stocks. So we've talked about buying a stock, but we've not talked at all about how we go about finding good stocks to buy. So that's all detailed in our methodology. We're always updating it. It's online. Just Google it, and then you can read about how we go about investing stocks. If you got questions, post them on the YouTube channel. Really appreciate your time. Make sure to subscribe as we're putting out more content, and we'll talk to you soon.